welcome Dr. C.P. Gupta sir on this day 5 of online short-term training program on financial analytics organized by IBMR IPS Academy. And before sir, I would like to first introduce our participants to you. So our participants belong to from a few of them are industry professionals, and people are from academic fraternity, research scholars, and freelancers. So we have representation from different parts of India. So that was participants were all about. Okay. And good morning, dear participants. So we are having Dr. C.P. Gupta with us for the today's session, and he is going to take session on data visualization and data presentation. And before we begin the session, I would like to introduce Dr. C.P. Gupta to our participants. So, Dr. Gupta is a professor of finance in the Department of Financial Studies, University of Delhi South Campus. He is MPhil and PhD in finance from Department of Commerce, Delhi University. He has worked as a professor in MDI Gurgaon, and also he served as a dean with Faculty of Commerce and Business, University of Delhi. Is having enriching 40 years of teaching and research experience, and he has published 30 research articles in several international and national journals, and also he's a author of 3 research-based books. Dr. C.P. Gupta has conducted several training programs related to accounting and finance for organizations like NTPC, IBM Daksh, EXL, ONGC, PowerGrid, IFCI, Fortis Healthcare, and DRIV.com. He has also consulted various projects, and he is also a member of Cost Accounting Standard Board constituted by ICWAI New Delhi. So once again, Dr. Gupta, on behalf of IBMR IPS Academy, I would like to welcome you to this. Thank you so much for being here. And now, yeah, and over to you, sir.
Thank you. So let me share this screen.
Yes, sir.
Deepti, I sent some file to Sachin. I hope he must have shared with the participants.
Yes.
Okay.
Yes, sir. We are sharing.
Okay.
Yes, sir.
Okay, great.
In few
Yes,
in a
yes.
minute we are sharing, sir.
Okay, so friends, welcome to the section on data visualization and presentation, and a very good morning to all of you. And hope we will have a lot of learning in this particular session, especially how to get best out of Excel. Okay, so let's start our day with God's blessing and with a lot of positive energy. Never forget, we have miles to go, long journey. Okay, still we have to go a long way. We are on a big journey, and hopefully we will move slowly and slowly and try to get more and more things about financial analytics. So get a lot of positive energy to continue with our energy, with our journey. Okay. So I hope you people are ready with the mindset that you are going to work with Excel, and you have to leverage Excel for understanding how to get best use of data in terms of the presentation and visualization. And friends, if you have any questions, you can unmute yourself, ask the question directly to me, and you can put your query in the chat box. But don't hesitate in asking questions. But make sure that you are understanding the things and you are getting the things and you are getting clarity, no confusion. Okay? So, with this, let's come back to our agenda. So when you see this picture of Albert Einstein, what's come to your mind? Anything?
Curiosity.
Intelligent. Okay.
Curiosity.
Curiosity. What else?
Satisfaction, very
Satisfaction.
happy.
Very happy. Okay. Great. So what does it mean? All this mean? But I'm looking at in a different way. Is hinting that you have to use your mind. Without using your mind, you cannot get the things done. So if you really want to get the things done from Excel, okay, you need two things. One, you have to use your mind to come out with precisely what exactly you want to do. And secondly, you have to master the tools of Excel. These two are important if you really want to get anything meaningful out of Excel. Okay. So two things we need. We must use our brain, the mind, and we must master tools. Both are important for leveraging Excel for our purposes. Brain is required because you must know what we want to do. If you do not know what you want, nobody can help you. You must visualize in your mind what exactly you want and how that can be done. That image, that visualization, you should have in your mind. Unless and until that visualization of the things happening in your mind, you can't get it done from any software for that matter, and especially the Excel. So, friends, if you want something to be done by using any software, you must know what exactly you want, and if you want that thing, how you can get that particular thing. Then ensure that how the computer will that job for you. And for that, you have to learn certain techniques, certain tools, and that's what exactly we want. So sharing that Albert Einstein, picture, I was trying to emphasize that please use your mind and brain and come out exactly what you want to do. How can you do it? Unless and until you have that clarity, you may not be able to get best out of Excel. Okay. So today we shall talk about data visualization and presentation, and it's full of challenges. I don't promise that I will be talking about all the challenges, but we will discuss certain challenges that will be helpful for us. Okay. So first, we have to understand, dynamic visualization, because many times you have to see same thing from different perspective. So how can you change your visualization dynamically? That is something we would like to appreciate. What does it mean? Let me share with you. So for example, I'm studying the share prices of the companies. So how to get the different prices just by the click. You see, L&T price, Infosys price, ITC price, Eicher Motors, S&P, Tata Steel. Just by clicking, you are able to get a new graph. Okay, so the issue is how it can be done. Do you understand what exactly I'm showing you? I have I have the data set with me of different companies, but I want to get graph of a particular company at a time. How to get that? I don't want graph of all the companies at a time. I want graph of any company which I decide to select. Okay, how do we do it? Any one of you? Any idea? How can we achieve such a dynamism in our charts?
Slicers.
Uh, Slicer, yes, you can make use of it, but at the back of it, something else should work along with slicer. But that's important. If you are teaching in finance, especially accounting and finance in the class, and you want to show that how different prices are behaving differently, you can dynamically change your graph and show that, look, this company graph looks like this company graph looks like this, and that's how you can do it. Okay, so I hope you have understood the issue which we are going to address. How to achieve dynamism in the charts. Okay, our focus will be identify the objective. Objective, of course, is we have to have dynamic charts which we can change as per our requirement, and we have to identify tools for providing that kind of dynamism in our charts. So we need two, and our agenda is identifying the tools for providing visualization and analysis of the data. And that can be used by making use of a function which is called offset function of Excel. It's an array function. And the moment you say it's an array function, what special point I have to keep in mind? The moment you say it's an array function, what is it that I have to keep in mind while using this array function? Any array function?
Arrangement.
No.
Control Alt and has
Yes.
to be pressed.
Simple enter will not work. You have
Con-
to press Control plus.
Alt.
Are you sure it's Alt or Shift?
I think, sir, Control Alt and one more key is required. Control Alt tab.
Sir, Control Shift and Enter.
Yeah, sorry. Shift and Enter.
You cannot press simple enter. If you do it, you might get some error. But if you use the Control Shift Enter, then it works. Okay, that's true for all arrays function which you use in Excel. Okay, so let's see what offset function is. Means distance from a point. That means we have a reference point. And from reference point, how you would like to go horizontally, that means column, and how you would like to go to the row. That means how much distance you will travel in terms of the column and the row. That offset function will be requiring as an argument or as an input. And of course, you need to have a reference point. Everything will be with respect to that particular reference point. It is one of the lookup or reference function. In it, one may refer to the range offset from a specified cell or range by the number of rows in the columns one may specify. This function focuses on a specific range and allows one to dynamically adjust this by defining rows and column offsets. Offset function allows us to introduce dynamism in our analysis. We can change our data dynamically using offset function. Use it in case where we want to change our charts and tables dynamically. And it plays a very, very important role in data presentation and data visualization. And let's see what are the arguments of this function. This is the reference point. From where you have to start your journey. From that point, you will like to move a column or row that you have to specify. So how many number of rows you would like to move? That number will be here. How many times your column should move? That will be here. And then how many data points you want to fetch? That's the height. Suppose I need 10, then the height will be 10. And if you need data in 2 columns, for example, that will be called width of the function. So these are the arguments one has to use. You need a reference point, how many rows and the columns you would like to move from that particular reference point, and how many rows you want, that is height, and how many columns you want in your output, that will be your width. Is a reference from which you want to base the offset. The number of rows up or down, plus means up, minus means down. Similarly, columns. Height is the number of rows that you want the return reference to be. Height must be positive number, and if you don't give it, by default, it will take its value as 1. The number of columns that you want return reference to be, With must be positive number, it's optional. If you don't give any number, by default, it will take 1. Okay, suppose I need data for Wednesday. I don't need the data for all the days, I need only for the Wednesday. So you have to first define your reference point. Suppose I define my reference point at this point. So the address of this cell will become my reference point. I'm not moving my rows 0, but I would like to move my column 1, 2, height. How many numbers we have here?
15, sir.
15. I need only 1 column, so width will be 1. So that's how you can use your offset function. Okay. So let's take simple example and see how do we do it. So I'm going to my Excel. We have a file. Suppose I change the date, Tuesday, and you will find your graph is like this. If I make it Thursday, you see your graph is like this. If I make it Friday, so now tell me what is the challenge in this particular designing of the graph. Of course, I'm using the offset function.
Maybe we cannot show 2 or 3 together.
Pardon?
We cannot show 2 or 3 days data together.
If you want, you can show it, but I don't want that. I want daily day data, only 1 day data. If you want to show 2 days data, that can also be done. That's not any problem. Okay, first, how do we get these options? Because if you see, how do we create this drop down list? I don't want to feed manually. I want to select from the drop down list. Anybody? How do we generate this drop down list?
I think there's a list. There's a thing which is
In
given,
data.
which is data table list.
Data. Okay. Then
It is given. Data validation, I think.
yes. So this drop down list can be created by making use of data. In the data, you go to data validation. In that data validation, you have to select list. And the moment you select list, you know what happens? It will ask you, where is that list? So you should be ready with that list. You must know where your list is. Okay. So before you use this list function of data validation, you must know where is your list. Okay, so in this case, I just delete it. My list is here. This is my list from which I want to select. Okay, I generate somewhere else. So data validation, allow list, source is this one. Okay, so now you can pick it up. Whatever day you want, you get the day. Okay, and I will want the graph, and for the graph I need the hours data. So you just copy from here, paste here. And suppose I take the Thursday data, which is this one. I make a graph. That's the graph which we have. Any question up to this point? I just take you here.
No, sir.
Any question, anybody? Now, I have another challenge. The data which we have here, if you change this data dynamically, if we change this, we have to change this data. Dynamically. And for that, we are going to use offset function. But before that, I need one very important input. Suppose you select Wednesday here. Then how do I know that from which column I should pick the data? Till now, there is no movement in my data. Okay. And how do I know that from which column I should pick up the data? How do I know that? बता सकते हो कैसे पता लगेगा कि कौन से कॉलम से पिक करना आपको? How will come to know? From which column I have to pick the data?
Index match function.
Huh?
Index match function.
That's complicated. Give me.
The plus and minus from our reference.
Pardon?
Plus and minus from our reference.
But how many times plus? How many times minus?
Maybe we have to define that for Monday to Friday.
Where you will define it?
No idea.
You have to define somewhere, no?
If function can be used.
Any powerful function. If you can use, but any powerful function, you can make use of VLOOKUP. And VLOOKUP is actually a replacement of find and match. Because if you can do the same thing with find and match, but that formula and the syntax will be complicated. VLOOKUP simple. Okay. So what I need to define for every day. Suppose I start from here. I copy suppose here. Okay. Suppose I say Monday means column 1, Tuesday means column 2, 3, 4, 5. Okay. Right. Then for finding out the columns, so we lookup value is this day, the Friday. Table array from where I'm looking at the value is this one. Column index is 2 and we want exact, so we get exact. So that means I have to move 5 columns from that reference point. So if you say here Monday, 1 time, if you say Tuesday, 2 times, if you say Thursday, 4 times. Is that clear?
Yes, sir.
Right. So now we are ready to use offset function. So select these cells, offset, reference point it's asking for, and my reference point is which reference point I should take. That's your judgment. Suppose I take this, right? From in, I need not to move to any zero. I should stick to the row 5. The movement of the row is 0. But I should move column according to my VLOOKUP value, which is 4. Height is 15. If you remember, width was 1. Shift control enter and you get the result. So now we are ready with it. You change it to Monday, you get graph for the Monday. You change it for Thursday, you get this graph. Friday, this graph. Tuesday, this graph. So that's how you can dynamically change your graph. Any question about this process? Okay, so if you want, another graph of the line, what I do is I add a column here. And I use I just copy it from here. Tuesday. Then I can add the data. Series name Tuesday. and the data is this one.
Offset function we have not copied, I think.
Yes. Now I have to change. So I need the second VLOOKUP value. Okay, that will be equal to, this is your Tuesday. Sorry, VLOOKUP second. That's your array. Second column false. So I use the offset function. My reference point was this. Then rows 0, column is this one, the second one. Height 15, width 1. Okay. And you can add the legends. Right. So now we are ready. We can have, I can change it to Wednesday. That's the graph which we look at. That we get Friday. That the graph we have it. I didn't add the data labels here. So, Madam, Dipti Madam, you can add as number of graphs as you want. That's not a problem.
Yes, sir. Sure.
Okay. Any question about it? Okay. Let's take another practice question. But uh, friends, if you are able to do it along with me, that will be very wonderful thing. So here, if I change these sales to 3 weeks, my data changes. 2 weeks, my data changes. Okay. Now let's see how do we do this. So I copy day here, and suppose I picked up because to define graph initially, you need some data, right? So I'm just taking arbitrary data. If you want a graph bar chart, you can make a bar chart. Okay, so I can change their colors. And you can have the data labels.
Sir, I have a question.
Yes.
When I'm copying this sales week one data in the other cells, the way you have done it, it is showing reference, reference, reference. So why it does that?
In your case,
Yes.
you should not reference by which reference?
It is not copying the numbers 9, 10, 12, 13, 15. So hash reference has,
From where
yeah.
you copied it? Have you
I
copied
just copied
something?
it from the table, yeah, here, like sales week one.
Do it again.
Okay. It is again showing the same. Then it is showing formatting, charts, tools, tables, box lines. If I, kind of click on the box, but
Uh,
it is not copying the way it is.
Nidhi, can you share your screen with me?
That won't be possible because I'm attending the class through phone and then I'm doing it on laptop. Otherwise, it's simple copying na, that you have done.
Simple copy. Are you using MS Office or Excel, or you are using some other spreadsheet?
I'm using Excel only.
I don't know. It should not be there
It should not be.
because I've just copied before you.
Yes, yes, exactly. So, I don't know. It is showing you can't some invalid cell
You try
reference.
with the second column.
Okay. Okay, what I'll do? Probably, I think I've copied it from some wrong. Now it is getting, yes, yes. Probably, I copied it from there, the drop down where the
No,
chart was being
no,
made.
no, no.
Yeah, yeah, yes,
That
yes.
was
Sorry for bothering. Yeah.
okay. So first, let me make a list. So go to data validation, and select the list. And this is the list which we have before us. And now you can see the drop down list is there. Okay. Second step which we have to do is tell the Excel from where how many columns or rows it should move. And for that we will be requiring the VLOOKUP utility. For that I just copy from here. I've given some number 1, 2, 3, 4, and then you can take the lookup value here. So lookup value is this one. Table array is this one. Column index 2, range 0, right? Now let's define the offset function. Now I'm ready with the offset function. Okay, so select this equal to offset bracket, asking for the reference. That's my reference point. Then asking for the rows, 0. Asking for the columns, columns are 2. Asking for the width, width is 5. Height is 5. width is 1. Then shift control enter. Now we are ready with the dynamic chart. Right, so I change here V3 for, look at it, 3, 2, 1, like this. So friends, I think you are now in a position to prepare a dynamic chart. Any question about it? Now we will go for more complicated processes. Okay, so think how will show the dynamic information. Okay, you have sales, you have like here, you have the company sales for the different period. Okay, and you can change your, you can get, so whatever information you need, you can, show it dynamically. Okay, think what is the input data you need and how will you design it. Because unless and until you know what is your data, unless and until you know how you are going to design it, you cannot get it done through Excel. So that activity must go into your mind and your brain should start working in this direction. Okay, we can also make use of the, sorry, if we take 10-year data, right? Colgate Palmolive India Limited, 10 years data. And I have done the index time series index analysis also for it. And we want to make it, their graph dynamically. How do we do that? Like here, if you okay, so I think let me do it fresh with you people. I want to make graphs for this. So first you take this, because you need to refer the row from where the data is to be picked up, and that should be numbered. So just copy from here, paste here, and you have the number. 1, 2, and then you get this. Okay. So this table will help me, in identifying from which row I have to pick the data. Is that clear? Then I need to make a graph, and for that graph, I need to have a drop-down list. Suppose I want to make a graph here. So I just merge and data validation, list, and my list is, this is my source of list. And to make it looks attractive, you can add some color to it. So for example, is that clear? So we are ready with the selection. That's one part of the story. The second part of the story is take some data and make the graph. And suppose I take any data here. Suppose I take this. And I insert a graph. Suppose I want a bar chart. Sorry. Actually, there was a formula in that. So I have to copy it again. And paste here as a value. And that's the chart which we get. You can add the data labels and you can format data series. If you want, you can vary the colors. सर मैं थोड़ी देर में बात करूँ सर मैं थोड़ी देर में कॉल करूँगा आपको ठीक right so what I do is I need to change the data of the graph. Suppose I take this. Okay. Right. So friends, I have to change this data dynamically. And how do we do it? That's what we have to understand. Tell me how you will do that change data dynamically. I need one VLOOKUP value so that I can tell from which row the data should be picked up. Okay, for that you should have this sales value will be similar to what you have here, because whatever you select here, that should be reflected in the, suppose I take shareholders one, that should be reflected here. So connect these two cells so that if you make any change there, you can get this change. Then we need VLOOKUP value. And the lookup value will be VLOOKUP. This value I'm looking at, data array is this one. And I have to pick the data from required data from the column 2, 0, and then pick it 12. So now we are ready to use my offset function. I know my reference point, I know my lookup value, and okay, now we can use the offset function. Offset my reference point is this. I have to move rows. How many rows I have to move? Sorry, this is my reference point. And how many rows I have to move? I have to move rows as per the lookup value. I have to move column 1. And then height is 1 and width is 11. Yes. Now we are ready for ready with dynamic charts.
So we are making for time series data for the actual data?
Yes, the actual data of the Colgate formula, the last 10 years data.
Taking time series data, I think, sir.
Yes, the time series data.
That is that's base data, which is index number, I think. That's
Yes, it's the time series data. So now if you change it, suppose I change it to find out the profit, how the profit sales are growing, that the way the sales have gone up. So the last, 10 years, the sales have increased 93%, while your profit has gone up more than twice. So profit is increasing at a faster rate than sales, that you can easily show it. And now you have a good tool in your hand. You can find out the cash profits. You can find out the, investments. Everything is with you. And that's the utility of this. Okay. Right. I don't know. Who was talking about slicer? Hmm?
Participant, somebody has asked about the slicer.
Yes, sir.
Hemendra sir, yes,
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 yes.
please ask.
Hello.
Yes, sir.
Yes, Amanda.
Yeah, yes, sir. Good morning, sir.
Good morning. Here what I'm doing is I'm using the drop-down list. If you don't want to use the drop-down list, you want to use the slicer,
Yes.
you can also do that.
Yes, sir.
Okay. How we are going to do that? That's the next thing which I'm going to talk about. Okay.
Yes, sir.
Slicer feature of the pivot table. Basically, slicer does the filtering job. So whatever you click, you will be able to filter it and you will select. It's a very powerful tool of, pivot table, and you can do a lot of things with the slicer. So we have to understand the concept of the filter, because filtering is a process that refers to displaying a subset of the data as per some criteria or as per certain conditions. If one needs to focus on a subset of a data table, she can filter the data using certain conditions. And that's what we say filtering of the data. So there are several ways to filter data in Excel, and one of them is slicer. And the best part of the slicer, it works on click. You need not to, write the complex formulas. You need not write certain program. Just click, filtering is being done. Okay. Slicer is more visually appealing method of filtering data. Slicers are particularly useful in making filtering process simple. Slicers are very useful and it's easy to see exactly what type of filtering is in effect. So that you can do by making use of slicer. Like here, you can select region-wise, item-wise, representative-wise, and come out with the ultimate result. Okay. How do we create slicer? You just go to the pivot table, and in that pivot table option, analyze, you will find the option of insert slicer. And you can insert slicer for any field, whatever you want. Okay. Create slicer as per your requirement, and you can create multiple slicers using one table, and you may also create multiple slicers using multiple tables. That's your choice. Whatever way you want to do it, you can do it. Now let's take some example and see how can we practice slicer. Any questions before we go ahead? Okay, what I do is I think, let me see how slicer works. Select this data, make a pivot table of it, insert pivot table, and suppose I take the pivot table within this, say this one. Okay, now do you see this option, insert slicer? Insert slicer, right? So suppose I insert slicer for the day. Okay, so insert slicer. Okay, let me hide it. Anyway, let it be here. Okay, and in this, what I do is show field list. I take the days here, and you know what happens? I click on Monday. Do you see? Tuesday, Wednesday. Sorry, I think I should not do it for the days. I need for the weeks. Suppose I need, say, Friday sales for the weeks. Uh, Let me do it at some other sheet so that you can. Suppose this is the data which we have, and suppose I make a graph here. I put day, I take first, and then insert a graph. So whenever you start preparing the dynamic chart, you have to first make a simple chart without doing anything dynamically in that. Just pick up simple data, don't do anything, and make what the date chart you want to have, design that particular chart. So once you do that designing of the chart, then you play with the dynamics of the chart. Okay. So what I do here, I create the slicer. So I insert pivot table and existing this H1. That's my table. I take the data and I give I click on slicer week 1 and I put this value here. Okay, then I need to create VLOOKUP value. One, two, three, four. Because for dynamism, you need the VLOOKUP value. So lookup value will be VLOOKUP. Lookup value says week. Data is this one. Second column, that's one. So now I'm ready for offset function. Offset. My reference point is suppose I take this as a reference, this as a reference point, then my row should be lookup value. My column is same 0, height is 1, and width is 5. And then you, okay, so in order to make it more, friendly, what I do is I hide these values. And now click on sales 4, you get the week 3, 2, 1. That's how slicer works. So instead of picking up the data from the list, you can pick the data from the slicer. And that's how you can do that. Okay, any question? Any doubt? Any query?
No, sir.
This requires a lot of
Participants, are you having any query? So you may ask now.
I've created a complex, suppose I pick up a company which is, say, Reliance Industries. So the latest price of the Reliance Industries was this. The annual return is coming to be 21.65%. the standard deviation is so much, beta is so much, and that the share price is, and we have certain fundamentals about the Reliance, net profit margin, earning per share, return on equity, price earning ratio, price to book value. All are being created in a complex dashboard. If you select a company, say Tata Steel, so that's the latest price, that's the annual return, that's the standard deviation, that's the beta of the company, and see the net profit margin is for the past few years going down, and it's gone up in 19, again gone down in this, and the company P ratio is this much, and that's your price to book ratio. So everything you can put at one place, at one sheet, but data is in other sheets. Like here, I'm picking up the company's data from here, net profit margin, return on equity, EPS, price earning ratio, price to book value ratio, all those things. Price data I'm taking from here, return data I'm taking from here, and the calculation of the average return, standard deviation beta, I'm picking up from this particular sheet. But all this had been put together at one desk board. Right? So, I mean, it's very useful when you go for some presentation. Somebody asks, I want to see the, basics, fundamentals of a particular company. You just click and everything is ready for you. You can also use it in your classroom to say, for example, if I take Nestle India, that's the price, that's the annual return on it, standard deviation, beta, and these are the net profit margin figures, EPS, price earning ratio, price to book value, and all that. Okay, any question if you have anybody? And I hope you will use this tool of dynamism for your own purpose, maybe for the purpose of teaching your students in the class. You can change your graphs, tables, whatever you want in a dynamic manner. Any questions?
Participants having any queries?
It says even if you knock it and no way to stop it. We are not going to stop and shall continue to move ahead. And yes, Nidhi, I will be sharing PPTs and all the Excel files with you. That's not an issue.
And participants will share the same files with you.
So what next that we will take after the break? Madam, we have a half an hour break.
Yes, sir. We are having a half an hour break, and we will resume session.
Reduce to 20 minutes or 25 minutes?
Yes, sure. So as you say, sir, we will resume this session at 11:50,
Yes.
as you say?
Yes.
Or 40. Okay. So participants will resume session at 11:50 sharp.
And
that be okay.
We will be going to talk about portfolio and how to come out with the optimum portfolio, how to draw the efficient frontier. All those things we are going to talk about in the next session.
Okay. Thank you. Looking forward, sir.
Okay. Great.
Okay. Thank you so much, sir. And we'll resume back at 11:50.
Right. How can I get this? Ah.
Sir,
You can
your
stop sharing your screen, sir.
Sir, actually, your screen is still on sharing mode, so you may stop the share.
Ma'am, you can inform him. I think he is gone. I think.
Yes, yes, it's done. Thank you so much, sir.
Huh?
Good afternoon, sir.
Good afternoon.
Welcome back, sir. Sir, I think you can start the discussion, sir.
Okay.
Yeah.
हाँ ठीक 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 Nidhi, sorry, Deepthi, sorry. I couldn't
No
call.
issue, sir. Perfectly fine.
Okay. Friends, let's start. And to begin with, it says learning is the only thing the mind never exhausts, never fears, and never regrets. And the fact you people are here in the session, that means you are determined to learn. And if you learn it, your mind will never be exhausted, never be full of fears, and you will never regret of your learning. And we have to do learning and only learning and nothing else. Okay. And learning is two ways. And again, I ask you, whenever you have any doubt, any query, please don't hesitate. Ask me directly the questions. Okay. Mr. Haminder, what's your background?
Hemendra sir, are you here? Hemendra Gupta sir?
Dipti, do you know his background?
Not actually. I have to look into my sheets to know. I think he'll be back in a moment or so.
If you know,
Hemendra sir, can you hear us?
no problem, madam, no problem. Uh, uh, Madam, you know anyone with the finance background in the department?
Yes, I think most of the academicians here are from finance background. I think we are having Chaya madam. She's a professor of finance from CMS Business School. So Chaya madam, are you here?
Yes, ma'am, I'm very much here.
Yes, yes. Sir is, asking you something.
Okay. So, Chayaji, maybe I put some questions to you. If you don't want to put any questions to me.
So yes, no question, but only disclaimer is that I'm a finance faculty by choice from the last 1 or 2 years. So definitely whatever I know, I will tell you, sir.
Okay, great. So it says, I hear and forget, I see and remember, I do, I understand. So doing is very, very important. If you start doing the things, you will understand the things. If you don't do, you will not be able to understand it. So please remember, you do, you understand.
Yes, sir.
Do, you don't understand. Okay, so I believe if we had a larger conception of our possibilities, a larger faith in ourselves, we could accomplish infinitely more. Believe in yourself. You have a lot of strengths. Play on those strengths, and that's very, very important. Any question before we go ahead? Any doubt, any clarity? People are looking forward what we had discussed in the previous session. No? Great. So let's see what next we are going to talk about. Uh, Now we are going to talk about portfolio analysis and Excel. So, friends, I would like to devote few minutes for basics of portfolio because that will help us in modeling portfolio in Excel. So we understand portfolio.
Sir, I want to request one thing from you.
Yes. Yes, please go ahead.
Sir, actually, due to network problem, I face a little bit difficulty in the first session. So if you can send your Excel sheet, what you did in the Excel sheet, it will be great help for me.
Okay. So, Madam, you can share the files with the participants.
Yes, yes, we will. We will definitely share the files from the participants as soon as you send files to us or to Sachin sir.
Yes. Dr. Salanki, I will be sharing files with Deepthi Madam and Sachin.
Yeah.
They will forward to you.
Thank you, sir. So nice of you, sir.
Okay. Anything else?
No, sir. Thank you.
उमेश जी आपकी background क्या है?
Sir, I am from finance. I did my MBA in finance and CFA.
Okay, great. So portfolio must be of interest to you, right?
Yeah.
So we define portfolios as combined in some proportion. So if you have securities, you combine in some proportion, you get what is called a portfolio. And when we talk about portfolio, we can calculate the return on a portfolio and risk of a portfolio. And for a two security case, Return is nothing but weighted average of the security returns. Weight of 1, return of 1 plus weight of 2, return of 2, and the variance of that will be weight 1, variance 1 squared plus weight 2 squared plus 2 times of weight 1, weight 2, covariance between 1 and 2. Alternatively, you have W1 is squared, sigma 1 is squared plus W2 is squared, sigma is plus 2 times W1, W2, standard deviation of 1, 2, correlation between 1 and 2. Friends, I'm presuming that you understand the notations. If you find that there is a problem in understanding the notations, please feel free and I will explain that notation.
The notations are clear.
Okay. Then if we have 3 securities, we can extend it. So return for the 3 security will be W1 return 1 plus W2 return plus W3 return 3, which is nothing but weighted average of WI return I. Okay, and the variance is W1 is squared sigma 1 is squared plus W2 is squared sigma 2 is squared plus W3 squared sigma 3 squared plus 2 times W1 W2 covariance between 1 and 2 plus 2 times W1 W3 covariance between 1 and 3 plus 2 times W2 W3 covariance between 2 and 3. Right, so like this, you can extend, and when you extend, you will get this. And if you take a square root of it, you get this standard deviation. Okay. To manage such a complicated calculations comfortably, you can make use of matrices. So I can express the same formulas in terms of matrices. So where W is weight matrix, you have W1, W2, and so on. And you have the rate, sorry, R, which is the return, R1, R2, like this. So the portfolio return will be the transpose of the weight into the return matrix. Okay. If sigma is my variance covariance matrix, then the portfolio variance will be equal to transpose of the weight into the variance covariance matrix, again into the weight. So by making use of these simple matrices, mathematics, you can easily calculate the mean and the variance of the portfolio. Okay. Markowitz, if you remember, questioned the concept of naive diversification. He said that by adding blindly securities into your portfolio doesn't make a sense. You have to be selective and select those securities in your portfolio which are having very, very low correlations or preferably negative correlations. So it may not be necessary that you go on adding securities and your risk is diversified. What determines the diversification of risk is the nature and the degree of covariance. Lower the covariances, better will be your diversification. So if you have perfect correlation, that's how you get a linear relationship. And if you move here, so your standard deviation risk is reducing, but your return is not coming down. And if securities are perfectly negatively correlated, then you can generate a portfolio which is having zero variance. Okay? And I hope you understand what we mean by diversification gains. Then if we are looking for optimum portfolio theory, we apply a principle which is called a mean variance dominance principle. And this says that a portfolio is dominating over the other portfolio if for the same or more expected return, a portfolio is having same or less risk. For the same or less risk, a portfolio is having more expected return. Then we say a portfolio is dominating the other one. And this principle takes us to the concept of efficient frontier. You can also create a minimum variance portfolio that looks like the Okay. Regarding this minimum variance set of portfolios, we have a very, very important theorem, which we must remember. And the theorem says if two or more portfolios from minimum variance are combined, then the resultant portfolio will also be minimum variance portfolio. So if I take two portfolios, P1, P2, both are minimum variance portfolio. You take a combination of it, that combination will also be a minimum variance portfolio. And when I say combination, I'm talking about linear combination. So if you get two minimum variance portfolio, you go on taking their linear combinations, you can generate a number of minimum variance portfolios. Okay, right? Then we have a concept of what is called a efficient frontier, and that's how the efficient frontier looks like. And every portfolio on efficient frontier dominates others. They are not dominated by anyone, but they dominate the others in terms of what is called mean variance. Okay, now any one of you tell me what is the connect between efficient frontier and minimum variance portfolio? Because the theorem which we discussed about minimum variance portfolio can be extended to efficient frontier.
The risk will be the least, sir, there.
Sir, optimizing return.
No, connect between the efficient frontier and minimum variance portfolio. Shai, you're trying to say something?
So basically, for a specific level of risk, efficient frontier gives the highest expected return.
Yes.
So if a minimum variance is there, so that means the return will be, I mean, the return will be the highest return at that particular level of risk.
Okay. Every efficient portfolio is minimum variance portfolio. But every minimum variance portfolio may not be efficient. Please understand that. The other way around is not correct. Minimum variance portfolio may be efficient, may not be efficient, but efficient portfolio will always be minimum variance portfolio. That means the theorem I was talking about, that if you have two minimum variance portfolio, right, then taking their combinations, you can have still a minimum variance portfolio. That I can extend to the efficient portfolio. If I take any two efficient portfolio, I can generate a number of efficient portfolios. So the linear combination of efficient portfolios will always be efficient. Is that clear? That's a very important theorem that we have to look at. Because many times I have to generate efficient frontier. So I need not to work out every efficient portfolio. What I do, I take two and then generate by taking their combination. Right? Jay, is that clear?
Right, sir.
And we all know that the this is the indifference curve map of the risk averted person, and where the point of tangency we get that gives the optimum portfolio for the investor. Okay. So now, what is the challenge before me? The challenge before me is one, how to get the portfolio return, how to get the portfolio risk, and how do we get the efficient portfolios, and how do we generate efficient frontier. So these are the four basic challenges which we are going to tackle in this particular session. Okay. So let's go to Excel, and we have a file with the name of portfolio analysis. Okay, one quick question. The market gives you prices, market never gives you return. Okay, how do we get return?
So today's price minus yesterday's price divided by yesterday's price.
Okay, so P1 minus P0, right? That's how we get it. Okay, many times we talk about log returns, which is defined as P1 upon P0, right? Which one I should use for portfolio? The log returns, this is called simple return. This is my simple return. This is my log return. Sachin, tell me, For portfolio construction, should I use the simple return or log return, or I can use any one of them?
Sir, anyone can be used.
Anyone can use. Anybody else?
A simple return?
Simple would do, I feel, sir.
Why? Why simple?
Because it's a percentage. So, I mean, the range wouldn't be so much that we need. There is a need for conversion.
Log return will also be in terms of percentage. Both are in terms of percentage. That's not the point.
Log maybe kind of standardizes the data.
No. Both are in percentage, so both are standardized.
Maybe it reduces variation.
No.
Because of X and Y axis to equate something, I mean, so that they're on the same plane.
There are percentages varying between, they're all percentages because you can take any value. Madam, I'm not able to see the whiteboard facility. Do we have a whiteboard?
Yes, sir. Yes, sir.
Where?
You do have a whiteboard.
Where?
Sir, please share your screen again. Therein you'll find the point of whiteboard.
I'm sharing my screen.
You have to stop sharing this current screen. Or new share. There is another option available, new share.
Okay. Okay, whiteboard.
Yes, sir.
I can't share both these things simultaneously.
Simultaneously. No, sir, you can't, but you can share one by one. I mean, new sharing is allowed, but that will by default, cancel the previous sharing.
That will create problem for me. Anyway, we can I can work with.
We can work with a new Excel file then to write.
Yes. We have to remember two important properties about simple return and log returns. Simple returns are additive across securities. While log returns are additive across time. Log returns are not additive across securities. And that's the reason because of which log returns are not allowed to be used for portfolio analysis. Is that reason clear?
Yes, sir.
Yes, sir.
Okay. So,
So please explain this additive thing. Like, what is this property?
additive means if you want to get, say, securities, suppose you have security A, security B, right? Security is giving me return 1, return 2. So I want to take some addition of it that I can do only for simple returns. I cannot add these simple returns. Sorry, I cannot add these returns for log. So for log, this is not allowed. And when I say time additive, that means you have day 1, day 2, day 1 return R1, R2, and I want to get the total 2 days return. Then I can add log returns, but I cannot add the simple returns. That's what that's what I meant when I said additive.
Yes, exactly. Now it's clear because otherwise, else obviously one can do fundamental mistakes.
Yes. So market gives you prices. These are the prices which we have, and let's calculate the return. I do it again. So the previous day price, sorry, the today's price minus the previous day price, sorry, this minus previous day divided by previous day, and that's the return which we get. Is that clear?
Yes, sir.
Then security returns are nothing but average returns. Okay, so what I say is equal to average of this and average of the other. Then we calculate the standard deviations by using the infill function STTP, and we calculate the sample standard deviation because the data which we have, that's the sample data. Okay, so we take the sample standard deviation of these
So kindly repeat, why do we take dot S?
because S for sample, P for population.
Yeah.
Since we have the sample data with us, so we cannot use the population standard deviation. I'm working with the sample, so I have to use the sample data, right?
My point was, can we not consider that as the population, because that is how much we want to know?
No. Population is the total universe. And from that total universe, what you take, that's your sample.
So you mean to say ITC Limited's all the periods data would be the total population, is it?
You're asking me a difficult question.
No, I because I got confused, sir. I'm so sorry.
No. Actually, even if you take this all available data of ITC Limited, I will say it's a sample data.
Yeah.
But you didn't ask me why. Because the time series which we have, that's a realization of the possibility, and that is again a sample. So time series data is always the sample data. Time series data can never be
Okay.
population.
From infinity to infinity.
Right.
Yes, sir.
No, infinity to infinity, the value, not the sample.
Yeah. No, that is the population, I thought.
Yes, yes, yes.
Yes, sir.
STTP and Infosys. Okay. I have the daily data, so I get the daily return. And these are your daily returns and associated standard deviation. How to analyze them? If I want to analyze them, how can I do it? How can we do the analyzation of these figures?
So with the formula, weight.
Analyzation
ITC has a negative return, sir.
doesn't matter. I'm not
Uh,
looking into the number. Number is not important for me. Whatever number it is, I want to analyze it. How do we do that? Analyzation.
Infosys has higher risk and higher return.
That's true, but that's daily data. No?
Returns can be multiplied by 12, or we can take effective of that.
12 is monthly. This is not monthly data. This is daily.
No, okay, sorry. Okay, it is, if it's a daily, then I can number of days I can multiply, and then.
So you mean to say multiplied by 360?
And trading days, number of days, I do not know how many days.
Okay, so normally we take
200.
250 days.
250 days, yeah.
Normally we take 250 days as trading days. Okay. Right?
Yep.
The standard deviation?
You multiply by square root of, I think, 250.
Yes. Why square root?
Because it's you have to square, you get the, this is under root formula for that.
Yeah, but why this formula? You should, as you're multiplying return with 250, you should also multiply standard deviation with 250.
Because while taking SD, I've taken the square root of variance also. That was.
So you multiply variance with 250 square and then take a square root of it. What's the problem with it?
We would have multiplied variance with 250 or standard deviation with root of 250.
But why that? My question is why that? Why you're not multiplying variance with the square of 250? Why not this? Okay. Two properties we have to remember. One, we are assuming that daily returns are independent of input. That's one assumption I'm making. Whatever returns you are having, we are assuming that daily returns are independent of each other. Second, if I take variance of x plus y, this will be equal to the variance of x plus variance of y if x and y are independent. So if you assume that variance is same and independent, then for 250 days, it will be addition for 250 times. Adding it 250 times. So the total variance will be this much. Then the standard deviation will be square root of 250. That's how we get this square. Is that clear?
Yes.
Yes, sir.
Okay. I'm not analyzing it, that we can do, but that's the way we can analyze it. Okay. So that's the correlation we get between these two securities. And suppose I take weight 60% and 40%. And then see how do we get the portfolio standard deviation. I think I should add one more column here. So I add here the 60%, and this is equal to 1 minus 60%. Okay, so my return will be how much? This into weight plus this into. That's the return which we get. Any other way, better way to get the return? There is a function which is called sum product. If you use the sum product function, then multiply the array of average return with the weights. You will get the same value. Okay. How do we get the variance? Variance will be equal to weight into standard deviation square plus this into weight square plus 2 times of weight this into this standard deviation into correlation. And the square root of it will give you the standard deviation. That's the standard deviation. Is that clear? And if you want to play with it, so if you want to play with the weight, suppose you have 50% weight, that what we get. If you have 40%, 60% weight, if you have 20%, 40% weight, That's what you get. And you can see here, as your risk is increasing, your return is also increasing. If you take it 80% and 20%, that's what you get. So you can show it like this. Any quick question? Then I would like to do it through matrices. I want to do the same exercise through matrices. Okay, so uh, friends, tell me, do you know how to name say cells and range? Because if you name the cells and the range, you can remember better where is your data is. And that challenge is naming of range or of your portfolio we can make by making use of solver, but I will come back to that. Just wait. Uh, Tell me, do we have, you know, the, do we know how do we name the cells?
I think we have to select that range.
Right.
And in the first box, we need to give whatever name we wish to give and then press Control Enter or something.
You need to
I'm forgetting it, but
okay. So what I do here is these are the weights. So what I do is I name them as weight. And when you give the name, you use the caps or use the small letters, doesn't make a difference in Excel. Both are acceptable. So this is my, sorry, why it is not accepted? Let me check. Okay, so weight is already defined. This is my weight. I've already defined this as a weight, and this I'm defining it as return. So if I want to get this, I need to have matrix multiplication MMULT transpose of weight comma return array function. So it should be entered by using shift control enter, and that's the return which we get. So by using matrices, you can get the result. Okay. And to calculate the variance by using matrices, you need a variance covariance matrix. Any one of you tell me how do we get the variance covariance matrix? How do we get the variance covariance matrix? Suppose I need variance covariance matrix. How do we get that? Anyone? How do we get the variance covariance matrix?
By using the MMult?
No, no, no. Anybody else? That you can get by using data utility, data analysis. In that you get the option of covariance. So my input range is the return. Sorry. My data is in rows. First column, the label. My output range is starting with this. And I say, okay. Sorry. I'm sorry. This is the return data which we have. That was the mean return. That the variance covariance matrix. And since it is symmetrical, so whatever number you have here, that you can take to get the complete matrix. And suppose I name it as covariance mat. How do we get the variance of the portfolio? By using the matrices? If you remember, weight transpose sigma, the variance covariance matrix, into weight. So I have to use MMULT transpose of weight again MMULT variance covariance matrix into weight. Is it clear formula? Anyone, any doubt about the formula? Is the matrix form which we are using? And then you say shift control enter, and that's what you get. You take the square root of it, you get the standard deviation. And if you take the percentage, okay. Now I have a question for you. First, are you comfortable with the matrix operation? If you're
Yes.
comfortable with the matrix operation, doesn't make a difference. You deal with 100 securities, 200, 10, 5, 2, doesn't make a difference. Simple. Second, do you see any problem here? This is my variance. This is my standard deviation. Do you see any problem here? कुछ प्रॉब्लम नजर आ रही है आपको? हेमेंद्र जी बताइए, यहाँ पे कुछ प्रॉब्लम है? 0.025% is my variance and 1.57% is my standard deviation.
So they're not the square. I mean, variance is not square of the standard deviation there, sir.
Okay.
That square and square root ka relationship maybe does not fit here.
Huh?
Square. So I mean, square of standard deviation must be variance, na?
Right. So take the square of it, you will get the same figure. I think, Chaya, you are very close to the point. Please. You know, variance is a squared quantity.
With the weights, should we have done something?
Percent square. It should be 0.025% square. You know why I am discussing this point? Because I have seen many times people are using variance in terms of percentage, which is not correct. The standard deviation you can use in percentage, but child variance we should not do it because variance is a squared quantity. So if you say 0.025% is my
Yes, sir.
variance,
Yes, sir.
incorrect.
Got your point, sir.
Okay, is that clear? Are you comfortable with matrix operation or do you have any problem in it? Okay, now you can play with this correlation thing. If you want to show the student that what happens when your correlation changes, then you can play with it. So if I increase my correlation minus of it, what happens? My return is not affected by this, but my standard deviation has come down. That shows that if you go on reducing your correlation, the portfolio risk goes on declining. So that's, you can show by changing the amount of the correlation in the data. Okay, right. If everything is being done, now we are ready for trying to get out the optimum solution. And that optimum solution, we must know what kind of optimization we want to do. What is that optimization problem here? What is that which we want to optimize? In portfolio, we minimize risk, which is measured in terms of variance subject to a given data. And what we have to find out? We have to find out weights. What combination of securities I should get so that I'm able to minimize my risk, that is the variance, subject to a particular amount of given return. Is that clear? So that's my optimization problem, and see how can we solve in this case. So for that, we go for solver data.
Sir, sorry to intervene.
Yes.
We can do it for multiple securities also, na, sir?
That next thing I'm going to do.
Yes.
Right now, I'm just looking at two, then I will go to the multiple securities. So to go to data, sorry, go to solver, and I want to minimize my variance. So I want to minimize my G13. G13 I'm minimizing by changing the variable's value, and the constraint is that the return should be greater than equal to, say, 0.0001. Okay. Is that clear? This is my
Sure.
objective function. I think I should also use some another. This is my objective. These are the variables which are my decision variables about which I have to take a decision. And that's my constraint. And I don't want to take negative values, so I take it to make unconstrained variables non-negative. Is that okay?
So why 0.001?
001 means? I have taken just arbitrarily. You can take any number.
Okay.
Say if you want to, sorry, how to, and suppose I want to change it. So I can change it. Sorry. If you want to change it, you can change it. Say I take 0.01. I've taken it arbitrarily. Then you say, okay, solve, keep the result, and that's the result which we get. I don't know why it is 440. Sorry.
So should we need to give the constraint that sum of weights equal to 100% or not?
Yes, yes, we should. That I didn't do. So if I put a constraint only on this variable, by changing only G8, because the other will be automatically changed. Solver did not find a solution because I've taken, I have to take a range every return between these two numbers. So I have to change my constraint. And suppose I take 0, 1, then I can solve. So if you have 34% of ITC, 66% of Infosys, for this return, your variance will be minimal. And that's how we get the optimum portfolio for a given return. You know what is this portfolio? This is nothing but your efficient portfolio, because this is the portfolio that's giving you lowest risk at a given level of return. So that's efficient portfolio. So whatever we have done for the two securities, now let me repeat the same exercise for more than two securities.
So can you again explain how you gave that weights constraint, sir, please?
Okay, I do that.
Thank you, sir.
Sorry. Go to solver. Suppose I delete it. I add a constraint. So what I am saying, my return should be greater than equal to a number. And that number should be between the average return of ITC and Infosys. Suppose I say I'm looking for a portfolio with zero return, for example, then I just add this. That's how we define the constraint. And I've taken one. You can have more than one. That's your choice. Okay. Anything else?
So that weights 100% you did know, sir.
Because I
G8 and G9.
like this, I tell you, because the second one is defined as 1 minus G8. So if you define this, the first one, second will be automatically coming, which will be 1 minus that. So the sum total will always be equal to 1. Right? So suppose I say it as, I put a figure here, 66%. And I take a sum total here. Then I need another constraint here. So what I can do is solver, add a constraint, and the constraint is this number should be equal to 1. Right, so now I have added it. Okay, so solve. And you get the same answer. If you change the return, if I change it, suppose I want to make it 0.0005, solve. I don't know why this is not coming. Sorry. I have to change both the variables now. That's what we did. Okay, so I hope you understand the matrices, operations of the matrices, and solve it. If you have any question about it, No, then we will move to more than 2 security. Yes.
Sir, what we have stated now is an efficient portfolio or optimal portfolio?
It's an efficient portfolio. Optimum portfolio will be obtained when the indifference curve map is tangential to your efficient frontier. That's how we look at the optimum portfolio. So here you'll see this is your optimum portfolio. And these are all efficient frontier. So what we have generated is efficient portfolio. And not the optimum portfolio. Okay? Is that clear?
Yes, sir. Thank you.
Right. So having understood all this, now let's move to multi-security case. So we have a portfolio. We have to get the average returns here and the standard deviations here. I don't need the standard deviation because that will be there in my variance covariance matrix. I need weights. And some
Sir, I have a question regarding the annualized returns, what we discussed. Can I ask, sir?
yes, yes.
Yeah. Thing is, we have in fact calculated the daily return and then annualized it. Is it possible to take the prices of the beginning of the year and the end of the year directly and then compute the annual return? Is it also an accepted practice?
I'm not able to get your name. Who is that?
I'm Senthil. Yeah.
Hello?
Hello. Can you hear me, sir?
Yes, yes.
Yeah. So the question is
Senthil.
like
Senthil, right?
hello.
Dr. Senthil, right?
Yeah, I'm Senthil. Yes, sir.
Okay.
Can I proceed?
Yes, yes, yes.
Yeah. So the question is here in this example, you have explained the daily returns are calculated, day by day returns, and then the daily returns we have annualized it. Am I right, sir?
Right.
For our is it also possible to alternatively do one more thing, like take the opening day of the year and then closing day of the year, and then find the difference, what we do for the daily return instead between the opening day and then the closing day of the year, and then also compute the annual return? Is it also an accepted practice?
Anybody like to respond to that?
So I think in this, what will happen is that only the two values are taken. The extreme fluctuations which have happened in between will not be taken into consideration, because we are taking the standard deviation by taking all the values, and by mean we are taking only two values. So I think that.
Dr. Senthil, did you get something out of it?
Yeah, I got the idea behind. Thank you, sir. Thank you for explaining.
Suppose the beginning data and the last data are extreme values because of some reason or the other reason, or they are the depressed values. You may not get the true value of the return throughout the year. So if you take the average, which is based on all available information of the year, that will give you a better estimate. Just by looking at two extremes, 2 points, you are losing a lot of information in between.
So Chaya here.
Yes.
So correct me if I'm wrong, but I understand that the average return may not change. So definitely, yes, for standard deviation, we need to have daily return. But even if we do like P250 minus P0 divided by P0, we may get the same answer, sir.
I don't think, ma'am, it will depend upon, because if there's a lot of fluctuation,
but
you may
all
not get
that
the same value.
fluctuation, no, all that fluctuation in terms of plus and minus, I feel gets captured in the last price.
Ma'am, it may, for example, it may happen at P0 and P250, you might have the same prices also. But
Okay.
in between P0 and P250, there have been a lot of variations have taken place.
Okay. Yes, sir. I think we need to, sir may help us, I think.
I think, madam, I didn't get your name.
Chaya, sir.
Chaya.
Yes, sir.
Okay. Chaya, I think, let me do some exercise for you, right?
Yes, sir.
And show you what happens. So I take a duplicate of it. So suppose I calculate the log returns. So I take log of this divided by log of suppose I calculate the log returns, right? I take the average. And my average is, you know, I think I need to have one year data to show you what you are trying to say. I just
So,
take.
sir, we may take 10 days and also try, no, sir?
Oh, that will not make a difference. I just take 10 days data. 1 year data, right? So I take 2018 data, right? This is my 2018 data.
Yes, sir.
Sorry, this is have to take the price data is 18 data, right? This is my, sorry. Date, just sorry, it is not coming the whole date. Anyway, let's forget about the dates. Something. Okay, so what I do is I take one company. Let's take in some. Some problem here. So I just take the return of it. Uh, I will not get the return for the first day. I will get the return for the second day. So we have ln this minus this. Hmm. So here I take return, for example, that's equal to ln. And suppose I take the average. And if I take the difference of last minus first, sorry, do you see a difference?
Yes, sir.
It will not be same
Yes, sir.
because, sorry.
The logarithm, sir.
I have to multiply it by how many days we have. Just a minute. 245. Because this is the annual return. So if I multiply it by 245,
It is the same, no, sir?
it is same. Why is it same?
So that was my understanding, that all the positives and negatives will balance it. So in such a way that, I mean, average taken this way or that way, you would get the same answer.
Okay. But if you take the simple return, it will not.
Then also it will come, sir. Simple will definitely come, sir.
No. If I take a simple return, this minus P2 divided by B2 . Okay, so if I take average of it, multiplied by 245, and if I take the last day figure minus P2 divided by P2, Sachin, are you there? Sachin?
Yes, sir.
Sachin Khan?
Sir, yeah, he is like out for a minute. Tell me, sir.
No, no, no. I have a specific.
He's okay. He's like he'll be back in a minute.
Why is it so that in simple you are not getting it, and in the log returns you get it?
Sir, no idea, but I mean,
Because
yes,
of that property. Log
okay,
returns are
yeah.
positive. So whether you take average and multiply, you just add, it comes to the same thing, no difference. Because how do you get a log return? Log of P1 minus log of P0. Second day, log of P2 minus log of P1. Third day, log of P3 minus log of P2. And you see all this get cancelled. What left at the end is your beginning figure and end figure. Because of the additive property of the log returns, so you take the average or you take the beginning and the last, the result will be the same, but that not be true for the simple return. And since we are using, the portfolios, I need simple returns, and therefore it is better if I take the average rather than the end results. So Dr. Santhil and Dr. Haminder, I think you got this point. And that's very important point. Actually, I didn't want to discuss that, but since it was not in my agenda, since Chaya raised this question, so I thought let me discuss this point. It's
So thank you, sir. Thank you, sir.
And we should understand that. Okay, so coming back to our multi-security portfolios, I need
Thank you for the clarity, sir.
I need the average return of the securities, and I got the weights, and this is my sum of the weights. %100%.
So sorry, you are asking something to me?
सचिन गायब हो जाते हो तुम
Sir, I went outside for a few minutes.
अब मैं पूछूंगा ना क्वेश्चन तो जवाब देना.
Okay.
So let me take the average of these securities return. So I calculate the average here. Sorry. These are my average returns. So what I do, I take a copy of it, paste as a value. And I take transpose of it here. So I'm giving it a name. Let's call it AVG return, RET, and let's give it a name as WT for the weight. What next I need to do is get the variance covariance matrix. And how do we do it? Let's look at that. So go to data analysis, variance covariance matrix. My data is in here. That's my data. Then label in the first row. Output range is sorry. Variance what it's doing is asking me to get the covariance matrix on the same sheet. So let me calculate the covariance matrix here. Then from here, I will copy it to that page. So go to data analysis, covariance, and the data is from here to here. And this is okay. So this is my P2. It's asking me to calculate the same. From here, I can copy and paste here. And the variance covariance matrix, that's what we get here. Right. So, what the problem here? This is giving me the lower values. It's a symmetrical matrix. So I should complete this matrix. And once you complete this matrix, that you can use it. So I have to complete this part of the matrix. So these are all transpose. So I copy from here, transpose here, copy from here, transpose here, copy from here, transpose here, copy from here, transpose here. I did some mistakes somewhere. I have to copy from here and paste. I did a mistake here. Sorry, I did a mistake somewhere. Let me check. Right now I get this. So I get a variance covariance matrix and I name it as variance covariance matrix covariance. Now I am done. So I've defined covariance matrix. I defined the average return matrix, and I defined the weight matrix. So I can get the portfolio return, that will be the weighted average, MNULT, that will be equal to array 1, which is the transpose of weight into AVG return. That's the portfolio return which we get. And I add one more line here, variance, and then I will take the standard deviation. So variance, if you remember, is the MNULT transpose of weight then MNULT net covariance and weight. And you take the square root of it. Sorry, it should not be in terms of percentage. Take the standard deviation of it, you get the, if you take the square root of it, you get the standard deviation. That's what we get. Any problem, any question about up to this stage?
No, sir.
Any question up to this stage? You know, dealing with matrices makes your efforts very comfortable. And if you name your matrices, it still make your job very comfortable. Once we have done it, then I am looking forward for an optimum portfolio. with a particular return, and for that I use solver. So I'm minimizing my variance by changing the sales, by changing the weight, which are this, subject to the constraint that return should be greater than equal to 0.00, say 8%, right? And then we have to ensure that the sum of the weight should be equal to 1. Then I solve. I get a solution. So one portfolio which I get is this one. That's my one of the portfolio which I get from the security. Okay. Second portfolio, if I want to have the second portfolio, and let's see how do we get that second portfolio. For second portfolio, let me take some different return. So again, I go to data, solver. Then suppose I take this time my return as 0.8%, point I get another solution. Any problem up to this point? You know what is the thing I'm going to do? I'm going to generate efficient portfolios. Okay, how do we get the mean and the portfolio variance? How do we get the mean? How do we get the mean? Recall, how do we get the mean? Transpose of weights, which are these?
Weighted average.
Sorry. Equal to MMULT, transpose of the weights. These are the weights multiplied by return, average return. What was that?
Column A is also selected.
Average return. $36. What is selected? Oh, sorry. It should start from B. Yes. Okay. And how do we get the portfolio variance? Portfolio variance is MMULT, transpose of the weights, and weights are these. NMULT covariance matrix, static matrix covariance in two weights. And then if you take a square root of it, get the standard deviation. Okay, so we did this. Now I want to generate a new portfolio. How do I do that? Suppose I generate 40 portfolios. Can any one of you tell me how to generate the portfolios? सचिन बताओ portfolio कैसे generate होंगे? This I can copy.
नहीं कुछ नहीं, एक सेशन चल रहा था अभी.
Session time.
Third portfolio कैसे generate होगा? Please understand what I said. If you remember, if you have two efficient portfolios, you can take a combination of it. That combination will also be an efficient portfolio.
So we can estimate the risk return and then we'll maximize that ratio.
But that will take long time.
For example, let me just calculate this in this cell mean upon SD, and then let the solver do the maximization of that function and change the weight accordingly.
I don't want to do that. That will take a lot of time. What is the advantage of that particular theorem, which says that you can take the combination of the two efficient portfolios, resultant will also be efficient portfolio. What is the meaning of that theorem in that case? Huh?
So we can take the combination of portfolio 1 and portfolio 2.
Right. So how to take, Dr. Umesh, how to take that combination?
In various proportions, whatever is specified in portfolio 1 and
What I
portfolio 2.
do is,
Average.
yes. So we have to take the weighted average. Okay. So what I do, I assign weights to the portfolio 1 and weight to the portfolio 2 and suppose I start with the 0.05. This will be 1 minus this. Then what I do is I add into it 0.05, copy it,
And drag it.
and let me drag it. So actually this is increasing, so going beyond that. Let me start with the smaller value, the 0.01, add into it 0.01, yes, okay. Right, so what should I do? This into
The percentage of different securities in a portfolio.
so I have to multiply this with this plus this. Sorry, I take this. So multiply this. So I should not change my column. So I freeze my column multiplied by this. Sorry, multiplied by this number. In this case, I should freeze my row plus this number where I should freeze my column into this number where I have to freeze my row. And then you copy this to all the values. That's what we get. So by generating two portfolios, you can generate a number of portfolios by taking their averages. And how you take these averages, that way. Okay, now this task is simple. I have to make a portfolio with mean and standard deviation. Okay, so I insert, make a scatter plot, and we take it to new sheet. Then let me check what A49. Let me check what is the series is. That's the standard deviation. So I have to remove this. Right, that's my mean. And I have to add here. I don't know. Just a minute. There is some problem in the drawing. I draw the graph again. So change chart type, scatter plot. Select data. My series 1 is series name is portfolio mean, and that's the data which we have here, and I don't know why this is not happening. Select data. That's the name. That's the name which we get. Variance figure I'm not able to get. Let's change. I think let me try again to make the chart. Insert. That's the efficient frontier we get. Sorry, I don't know why it was taking time to make the portfolio chart. That's all. I I change the excess. Minimum is say 0.03. Eight, 5. That's how you got it. I don't know how I'm getting this value. This is
That is maybe because in the data there was one average, sorry, one return which was like 109% somewhere, sir.
okay. Maybe because of that it's happening, but
So
otherwise.
I saw it at that time when we had that entire sheet.
Okay.
But I just
know why that is happening. It is because of the fact that COVID period, right? So during that COVID period, there was a, or maybe some split of the shares. I have to take care of it.
yeah, no, one share's value, maybe that outlier was there, sir, that I saw at that time.
Maybe. You're right.
Sir, it may be possible that it is only taking the upper part of the frontier.
Efficient frontier means upper part.
Yeah, upper part of the efficient frontier.
Right. If you extend it, say if I extend these values, and suppose I take BW, if you take more point, you will get more clear picture.
Yes, sir. Now it is moving towards that.
Right. So if I take more, I think I can generate now. It will not take much time. CP. Now it's giving you a better shape. Then you can do the beautification of it. And I reduce the marker size. Right, so that's how you get the efficient frontier. If I increase that data further, and you will find still have some scope here. Then CW. Do you see this? How nicely it has come up. So I repeat the process which we did in the construction of the portfolio efficient frontier. We got the average returns. And since we are working with the portfolio, we get the simple return. And then we define some weights, and then we get the variance covariance metric that we got from data analysis tool. Okay, so we calculate return and variance and the standard deviation by using the formula that variance is equal, return is equal to transpose of the weight into the return matrix, and the variance is transpose of the weight covariance matrix. And we use 2 times solver to get the portfolios, these 2 portfolios. And we calculated their mean and standard deviation variance, and then we generate a number of portfolios by taking their linear combination. After that, we plot all these points of the mean and the standard deviation on a chart. And finally, we get efficient frontier. So friends, I think you need some time to work on it. Okay, so, but I'm sure that you can generate efficient frontier by making those up. So you must learn how to use solver, covariance matrix, how you got it, and you should be comfortable with matrix operations. If you do it, you will come out with a nice efficient frontier that you can share with your students, and you can take them to the classroom and talk about this. Okay. That's how we get this. Any question? Anybody? I'm sorry I extended a lot of time. It took a lot of time. But
no issues, sir. No issues. The learning is more important.
So we can also create optimal portfolio just by reading the solver.
No, you cannot, because to get the optimum solution, you need a difference curve map of the investor.
Okay.
You need to draw this indifference curve map.
Okay.
Without that, you cannot do it. Dr. Senthil, any question? Dr. Umesh?
No questions, sir.
No, sir. It was a very nice learning, sir. But I will request you to send the Excel sheet, worked out Excel sheet. So it will definitely assist us.
Chaya, how you are feeling now?
Excellent. And I don't know, but one thought I had was one life is not enough to learn it, sir.
Definitely.
And how many your years of experience and your grasp on the subject was clearly visible at every point in time, sir.
Okay.
Thank you so much. Thank you so much, sir.
Thank you.
Wonderful session, sir. Thank you.
Yes, Dr. Senthil.
I mean, the session was very wonderful. The depth with which you clarified the doubts was phenomenal. Thank you, sir.
Okay, thank you, Dr. Senthil. Yes, Sachin.
Thank you so much, sir. And you have explained quite technical aspect of, right from plotting graphs and putting dynamism into it and creating efficient frontier. So on this note, I would like to invite Priyanka Tawar madam to summarize this session, and as well as to give vote of thanks to Dr. C.P. Gupta, sir. Priyanka ma'am. Priyanka ma'am, are you here?
Yes, ma'am. Kitty ma'am. Am I audible?
Yes, ma'am. Please go ahead.
Okay. I, Priyanka Tawar, on behalf of IBMR IPS Academy, express my sincere thanks to Dr. C.P. Gupta, sir, for giving an excellent knowledge and coverage on data visualization and presentation and on portfolio analysis. I must mention our deep sense of appreciation to Dr. C.P. Gupta, sir, as starting the session with lots of energy and positive energy, as he recalls us about a famous scientist, Albert Einstein, that how to use your mind and how to come out with it. Thank you so much, sir. I'm also very grateful to sir, as you mainly focuses on dynamic visualization and how to achieve the dynamism for the charts and various tools. You also tells us about the offset function and the array functions in the Excel, even how to apply the offset functions in place of drop-down list. In deeply, you said about the different offset functions, which the 5 inputs, starting point, row point, column point, height, and width point. Thank you so much, sir, for giving us a deep knowledge about this offset function.
Thank you, Priyanka. Thanks a lot. Thanks, everyone.
You also, sir, now.
Good time.
Sir, one pointer. You also major focuses on VLOOP functions, how to use the VLOOP functions and calculate the sales data and how to make the dynamic charts. Sir, you highlights on the dynamic informations using the slicer. And we learned so many several things about the slicer and how to filter the data in the Excel. Thank you so much, sir, for clearing the Excel for how to clear the, how to sort this data and how to filter the data from the Excel. As today's scenario, we can learn about the portfolio. As you very well explained about the portfolio and portfolio analysis and efficient frontier. You also, sir, focuses on the two securities portfolio, which we learn a lot, and how to calculate the average return, standard deviation, variance, covariance, and using the various data and how to calculate and got the efficient portfolio. So thank you so much for explaining us with the different companies' data. And you also explain us the metrics operation, which is most important for us, and what the changes, correlations exist over there, and how we can solve that problem, and how we can achieve this optimum solution by minimizing this risk and to get the return. And I think that the return is most important nowadays for us. More and more return everybody expects from us. Thank you so much, sir, for your valuable knowledge and for sharing your valuable thoughts with us. Thank you so much, sir.
Thank you. Thanks, everyone.
Thank you very much, sir, for enlightening us on all both the topics, visualization and presentation, as well as on efficient frontier theories, as well as how to apply these theories in Excel. From on behalf of all the participants, IBMR IPS Academy and AICT, thank you very much. Dear participants, we know that to improve all this knowledge, we need a lot of practice. So, of course, these presentations, these sessions, we are recording continuously. This would be available on our YouTube channel, IBMR IPS Academy, and you can access the recording. If you have any confusion, you can use these videos. You can access YouTube channel of IBMR IPS Academy. You will find out all these videos easily. And you will get all these details again, you can check it. So that's it from my side. Thank you very much. Over to Dipti ma'am.
Thank you so much, Priyanka ma'am, for beautifully summarizing the sir's entire session. And once again, Gupta sir, thank you so much. Thank you so much for such a enlightening session. And before we sign out from here, dear participants, it is to announce that we are going for a break till 2:45. And at 2:45, we all together join again for the Pranvesh Chatterjee sir's session on portfolio management using R. So we are going to gather here back at 2:45 sharp. Thank you so much. Thank you so much, everyone.
Thank you.
Thank you, sir.
Thank you, sir.